Your home's appreciated, you've got equity, but can you actually tap into it without having a monthly debt payment, as well as not having to sell your house? That's what we're going to talk about today. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you, those of you that work so hard for your money, and you're now ready for your money to start working harder for you today. You want that freedom. You want that cash flow right now, not 30 or 40 years from now, but you want it today so you can live that life that you love with those you love. You want to become work optional, where you work because you want to, not because you have to, because you have enough passive income coming in to cover your needs and protect you and your family and be able to live that life that you love. But guys, it's not just about living a life of comfort and convenience. It's not just about getting rich, but it's about living a rich life. Because as you're blessed financially, as you have greater means and resources, you have a greater ability to be able to not only fulfill the measure of your creation, but also bless the lives of those around you. Guys, thank you so much for being a part of this show today. Those of you that have been binging, you've been sharing this podcast with others, thank you so much, because this ripple effect happens because of you. Hey, one little ask here from you guys, if you wouldn't mind, like and subscribe to this channel, this video, if you haven't done so already. And if you haven't done that, great, then feel free to share this episode with somebody else, because I can guarantee you this episode, you're going to love it and you're going to want to share it, because it's something that most people have not heard about. So be sure to do that now. All right, guys, so I brought back, third time's a charm, I brought back Matthew Sullivan with us. He's the founder of Quantm RE. He's also, done a lot of things in the crowdfunding space. He's also even worked with guys like Richard Branson. If you guys happen to know the Rebel Billionaire, right? And those kind of things with Virgin. He's got a great background that way. But I brought Matthew back on because the last two times, it's interesting. Sometimes you're just not ready for what we're teaching. And I believe now is the exact time. It's at that crux period where I think more of you are ready to listen, because if you've been in a situation where you've noticed that the last few years or so, interest rates have been higher for longer. You remember when people were saying back in 2023, 2024, oh, rates are going to come right back down. BS. It didn't happen. I told you, and it didn't, right? And now they're even talking about the rates are going to stay up higher for longer, and they may not come down at all for the rest of this year in 2025. And for that reason, many of you are starting to wonder, like, okay, but despite these rates still staying higher, my house still has equity. I still have money in this property, right? What do I do with this equity? Could I be doing something to invest it to not only make my mortgage payment for me, but maybe it'll speed up my progress to be able to become financially independent faster? Well, Matthew's got that kind of solution right now. So, Matthew, welcome back to our show.
Thank you, Chris. Thank you for having me back again.
Yeah, that was probably like the longest, intro slash topic intro I've done for somebody.
I was busy making notes there, actually. So thank you for that. Yes, you'll see that in my next presentation, word for word.
That's right, exactly. Well, give us a little bit more about your background for those that maybe not have seen the last couple times, because I think the first time we had you on was probably right around 2020. And of course,
Yeah.
rates started dropping like crazy. So a lot of people were doing HELOCs back then. And then we had you back on last year because rates were higher, but people were kind of in denial that the rates were going to be like this. And now I'm having more and more people asking me about, wait, is there a way you can actually get your equity out without having to pay a debt payment? Like, is there actually a way to
Yeah.
get the equity out and not have to pay anything? And I said, man, okay, if I'm having multiple people asking me this because there's different people trying to teach us stuff, I got to bring back the original guy that we had on that obviously has
Yes.
been doing this for many years, unlike some of these other players that just showed up last minute, right? So,
Yes. And thank you. I mean, it is it's very interesting because it's an asset class that we started getting involved with in 2017. So
mhm.
that's going to be, 8 years at the end of this year. And what we're talking about is called a home equity investment. And it's gone through various different namings. And some people refer to it as a home equity agreement or a home sharing agreement. But
Mm.
as more and more institutions get involved, it's now become more widely known as a home equity investment. And as its name suggests, it's a way for homeowners to unlock the equity in their home without having to borrow more money. And the way that it works is It's an investment from us or from the investors that we represent into your home, which means that you get, as a homeowner, a cash payment, which can be up to $500,000 in exchange for a share of the future value of your property. And you don't have to make any monthly payments because it's not a loan. So there are a number of things that go against the grain. In other words, they're not intuitive. So when we talk about a home equity investment, people naturally assume it's another type of loan, but it's not. It's actually very different because a bit like when you buy shares in a company, we're buying the equivalent of shares in your home. We don't go on title as an owner, so that means we're not going to come and camp out in your spare bedroom. You maintain all rights and privileges of home ownership, so you get to maintain the property is yours. But at the end of 10 years, which is the type of agreement that we operate, you then have an obligation to pay us a certain percentage of the value of your property at that time. And we agree what that percentage is going to be at the beginning of the agreement. So lots to unpack there, but in sort of simple terms, what we say is we'll invest a certain amount of capital with you today. You don't have to make any monthly payments. It's not debt, so it does not go on your credit report as another loan. You can use it to do whatever you want, and most people use it to pay off expensive credit card debts, and that alone can save an absolute fortune in terms of interest payments and monthly outgoings.
Yeah.
At the end of 10 years, then the amount of the percentage of the value of your home that we've agreed at the beginning, that then becomes due. And during the 10-year agreement, at any time you can pay us back and there's no early payment penalty. And one final thing, Chris, obviously, because you're talking about interest rates, all of those people that have locked in a low interest rate on their first mortgage, let's say 3.5% typically, that's now an asset if you think about it. You want to hang on to that. You don't want to let that go. You don't want to do a cash out refinance on your first mortgage because you're probably going to double the interest payment on your existing mortgage before you get any cash out. So you're right that in an environment where interest rates are remaining relatively high compared to what they were when you locked in your rate, this is a great way to access capital. And most importantly, it's a great way for people that don't qualify for a loan or don't get the loan that they want on the terms that they want. So it's a great alternative.
Yeah. Well, I definitely agree with that because that's always the big fear, right? Because I know I've got a 2.75% jumbo loan that one, I don't want to refinance, but two, I never want to pay off anyways, right? So
Exactly.
really
Why
my
would
only
you? Exactly.
other
Yes.
option besides yours is to do a home equity line of credit, but now I'm going to be paying 8-9% a year on that home
Yes.
equity line of credit. And I have to make payments every year or every month.
Yeah. Yeah. And that's the thing, it's the cash flow. It's that extra payment because you get the
Yeah.
debt, you get the lump sum, but unless you're very careful with what you do with that money, in most people's cases, you just end up with another monthly payment because,
Mm-hmm.
the HELOC is not normally used to pay off debt, so, people have all sorts of different things that they do with their money. But yeah, but another very important thing is that this type of solution is now beginning to get momentum because it's been around for over 10 years.
Mm-hmm.
There are now 7 or 8 companies doing what we do. So we're one of the smaller ones, even though we were here at the very beginning. There are a number of companies like Point and HomeTap and Unlock and Unison that are significantly bigger than us and do far more deals than us. But that's great because they create momentum in the space and they attract investment from institutions. And over the last 2 years, we've seen lots of securitization activity. And what that means is that the product, the home equity investment asset, is becoming much more like a mainstream asset that institutions and pension funds invest in. So rather than being relegated to being that investment asset class that no one really knows about and no one's interested in, it's now the opposite. More and more people are becoming interested in it as an investable asset class because there are things you can do with it that are very interesting and very profitable for banks, such as securitization. So last year alone, $700+ million worth of home equity investments were securitized. And really what that means is it feels and is growing into much more of a mainstream product. And at the same time, it's still very different to a loan. So from a homeowner's perspective, it's a very good time because the product, you've got more and more people getting involved in a $35 trillion marketplace. So, there's over $35,000 billion worth of equity in residential homes in the US. So we are not even scratching the scratch on the surface, with the amount that we're doing at the moment.
Yeah, I see two really big applications here for a lot of the people listening today. And I know this because many of you guys have, speaking to listeners, right? Many of you guys have gone and filled out our passive income calculator. And one thing that we even though we do factor it in that calculator, we make it a very small factor is home equity, both in the property, like your home, your private home, your primary residence, as well as with your investment properties. And that's the big thing is like, even when we calculate home equity, one, we only go up to 80% of the home equity, but then two, we only give a 2% spread because, if you do the math, say that you do get an 8% home equity line of credit, and that's $100,000 you're able to pull out, you're paying, essentially $8,000 a year, we'll say, just keep math simple. But if I'm earning 10% on that same, that same money, that same 100,000, I'm earning 10,000 a year. So I'm netting $2,000, which isn't bad, but it's not anything that's going to make you rich, right? Yeah. But if I know I don't have the payment, now I get to pocket all $10,000 of it, right? Granted, I know with Matthew, with you, like we still get to pay on the back end, right? There's still an interest. You're still making money. It's not like you're doing this for free. You still have that equity interest on the back end, but it's based on the appreciation, not based on, really this, whether the property appreciates or not. You have to figure out how to come up with that money. It's like debt, in that sense.
Yes.
So it's a much different situation. So I see that, but I also see the fact that I have so many people ask me, they're saying, you know what, Chris, I think I'm just going to cash out refi all my investment properties right now, and just pull out of the equity. But every time I run the numbers, I'm like, you'd be better off selling that property. It's not worth doing the cash out refi because you're going to lose more cash flow and you're not going to net as much. But here, this could be another option where they get to keep the property, keep all the tax benefits, keep the appreciation, but now they have access to that equity to invest in other places.
And one thing is very interesting about this type of product is the tax treatment. What you're effectively doing is you're selling some of your home value at a loss because you're paying us more than effectively what it's worth to you because that's how we make our money. Now, because of that, that's a capital loss when it comes to the tax treatment. So if you were to sell your property and pay us off that way, then you can use the amount that you paid us to increase your cost base. Right. And that means that rather than all of the, there's no tax obviously on the money that we give you because you've paid more than we give you. But it means that you can reduce your capital gains tax liability. That's right. So that actually brings down the real cost of our capital to something that in many cases will be significantly less than a HELOC. Yeah. Now, obviously, the caveat is, get your own tax advice. But this is why this type of structure is very different to a loan because you have that capital gains tax treatment or the capital loss treatment. And if you factor that into an overall passive income strategy, that becomes quite important. And your point is exactly right. You've got the additional cash flow of having those monthly payments that you don't need to pay. So you can make those work for you as well. And you at the end of the 10-year period, there is going to be a lump sum that's owing to us. So you must factor that in. You've got to think about how you're going to pay that back. Because if you don't want to sell the house, then you've got to think about what options you have. And those options include refinancing it with another home equity investment or some other type of, some other type of refinancing. But it's very interesting, and you need to look through a very different lens when you look at this structure, because it brings in things that you're just not used to as a typical loan, if you're looking at it as if it were a typical loan product.
Yeah, no, it's true that there's so many different directions. And that's what I love. Like, I know some people don't like having options because it requires more responsibility. It requires you to actually use
Yes.
your brain a little bit.
Yeah.
But I believe that's where there's freedom too, because when you have that option to be able to maneuver and move, let's just say that rates do just drop to nothing. You might say, you know
Yes.
what? Let's pay you off, Matthew. Like I think I'm good. I think I'm willing to take this,
Yes.
5 or 6% home equity line of credit now because rates have dropped again. But if they don't, hey, I'm so grateful I don't have to pay all that interest. I can still make money. And I know for myself, if I borrow and if I do the same kind of strategy, right, with you, I know that in 5 to 7 years, I can easily double my money, right? I can double my
Yes.
money at least within 7 years. Even if I go the full 10, I know I could probably make at least 150% on my money conservatively with the different strategies that I use with real estate. And so
Yes.
that's where I mean, I think it's a no-brainer. Like even on the back end, whatever we agree with you, it's not going to be anything more than what I make on the front end here.
And the other way of looking at it is a diversification strategy. So
Yeah.
again, you're not looking at this necessarily as a homeowner looking at this as a way of getting some cash just to pay off some debt.
Yeah.
If you're applying these types of thinking processes, which are much more strategic, then you're saying, well, actually, a lot of my wealth is concentrated in a single illiquid concentrated asset, my home.
Mhm.
So I actually should be diversifying out of that anyway, because
Yeah.
why would I have all my eggs in one basket? And people say, well, it's your home. Yeah, but still, I can't get my money. I can't get my hands on it. I can't do anything with it.
Hmm.
It's outside of my control. I cannot generate cash flow unless I start renting, portions of the property out. So this is a very good one. Now, there is a cost to this money. Yeah,
Hmm.
fine, of course, because that's how it works. But the way that you get this capital without the monthly payments makes it a very good candidate for a diversification strategy. And that means you can then do what you were talking about, which is put it into places where you have control, where you've got the opportunity of making a much greater return than you would have made had you left it in the equity in your home.
So true. Well, it's that speed. Like speed is everything when it comes to creating wealth faster, right? And that's what you really open up the option for us to do.
Well, it's speed and choice. It's the ability. I think you're absolutely right. It's the ability to react to situations, to move it according to your time zone, so your time scale, as
Mhm.
opposed to waiting for something to sell. So, in other words, you've got that cash available, and you can then be nimble with it. You can be just decisive with it and take advantage of opportunities as they arrive, as opposed to having it stuck in your home where you literally have to follow the course of home price appreciation and pray that somebody builds a very large something near you that will help your house price go up in value.
Yeah. Let's go with a few situations here. Let's just say that between now and the time that I sell a property and we have an agreement together, let's just say that the property doesn't appreciate at all in that period of time. What happens for you? Like what happens in that scenario?
There are a number of different models
Hmm.
and ways that home equity agreements are calculated, or home equity investments are calculated. Now, they typically break down into 10-year agreements and 30-year agreements. The
Hmm.
30-year agreements are provided by Point and Unison. 10-year agreements are provided by HomeTap, Unlock, and ourselves, Quantm. So the 10-year agreement is an exchange where a certain percentage of today's value
Hmm.
in exchange for a fixed percentage of the future value. So let me give you an example. You have $1 million property, and let's say you've got a $500,000 mortgage. So you've got $500,000 worth of equity.
Yeah.
We would, and you, let's say you want to unlock $100,000.
Hmm.
So we would invest $100,000 with you today, which is 10% of the current value.
If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
So if it's $1 million, $100,000, that's 10%. And our agreement would say, in exchange for, we'll give you the $100,000, which is 10% of the current value, in exchange for 20% of the future value, which you must pay at the end of 10 years or sooner. So you've got up to 10 years. Now, there's a cap on earnings. So if you decide to pay us back next year, let's say you sell your property or you refinance it, then we won't say we want 20% of the value at that time, because we have a cost cap. And the cost cap says that we'll take the lower of 20% of the value of your property, or your existing, the amount that we invested, plus an annual cost cap of, let's say, 19.9%. So at the end of the year, we say, you say, great, I've got this refinance possibility. I want to buy you out. How much do I owe you? So the original deal was 100,000. 20% of the value of your property. Let's say your property hasn't gone up at all, as you were suggesting. So 20% of the value of your property would be 200,000. So we'll park that here, and $100,000 plus the cost cap of 19.9%. That would be 119,900, which is obviously a lot less than 200. So you would pay, 119,900, and it's the same after 2 years. You would pay about 143,000, something like that. And then after about four and a bit years, the lines sort of cross over. So it becomes less expensive to do the 20% of the value of the home. Now, even if your home goes down to $800,000 for some reason, let's say there's some strange set of events that causes home prices to collapse, we still stick to our arrangement. So it would be 20% of the value of that property, as long as the reduction in value is down to external circumstances. So obviously, if you've let your house fall into disrepair, that's on you. So we'd find we'd actually add that to the amount that you owe us. But if there's a general collapse in house prices, then we would get back a lot less. And similarly, if house prices increase, we get back more. If house prices remain the same, we've got that 20% in exchange for 10%. So we've got that built-in discount, and that's how our interest is protected. So even if the house doesn't go up in value, we still make a return because you've said you'll give us 20% of the value of our property. But we've said, don't worry, we'll put an annual cost cap on that. So does that make sense?
Yeah, it does. Definitely. Yeah. So definitely if there's appreciation, that's great too, right? Just depending on what year it happens. But it definitely sounds like for somebody, if they really want it to work and make their money work harder, that longer term, the better.
Yeah. And in fact, if you do run it for the full 10 years and house price appreciation is 3% a year, then the actual cost of capital is about 11 point something percent, 11.4%,
right,
which is actually quite close to what it would be if you got one of the more expensive HELOCs. But that doesn't take into account any of the tax benefits. So that's obviously more complex because it depends on individual circumstances. So it's not massively expensive, but also you've got to remember the additional money that you could have made because you've got the cash flow benefit of not having the monthly payments.
You don't have that monthly drag. Yeah.
Precisely. So if you start factoring all those things in, that actually brings the cost down a little bit more. So over the longer term, the longer you have it, the less expensive it becomes. But
Mhm.
obviously, if house prices rocket up, then that changes that figure as well.
Yeah, that definitely makes sense. That's great. Is there a cap of how much loan to value you're allowed to do or how much equity
Yes.
you're able to
So
access?
we've got a few goalposts. The first is if you add the amount that we invest to your current mortgage, the combined lean to value must be 70% or less. So
Hmm.
again, that $500,000 mortgage that you have on your $1 million property, the most we would be able to invest would be 200,000
Right. Up to that
because
70%, 700,000. Yeah.
exactly. And on the other side, the other goalpost is let's say that you own your home free and clear.
Hmm.
The maximum that we would invest would be about up to 25% of
Mm.
the value of your property. So we wouldn't go more. Let's say your $1 million home was owned free and clear. We wouldn't go more than $250,000 in that case.
Interesting. Why is that? Why is it different there?
It's because, and there's a cap of 500,000 totally as well. It
Mhm.
just means that you might have a $200,000 mortgage, for example.
Mhm.
Um, so that's 20%. So we wouldn't invest 50% of the value of your property. Do you know what I mean? So the
Mm.
most we would only ever go to 25% because we don't want to have more than 25% exposure to any one property. That's just our modeling, and
I
it's
gotcha.
pretty much the same across the board. You just don't want to have that sort of too much concentration into someone's home. You don't want to own their home. You want them to own their home. You want to be a partner in it.
Yeah.
But if we took 20% of the value of your property, that would equate to 40% of the future value. So, that's getting quite chunky. So we don't really want to go, typically the most we go is 20% of the current value because that equates to 40% of the future value. And that's really enough. We don't want to, we try not to
You want to take all the equity.
you don't really want that. You want the homeowner to have as much equity as possible.
Of course. That makes sense. Yeah. Now, the process wise, is it a pretty lengthy process? Is it difficult to get through? And the reason I asked, because I had one client who used another company. She didn't know about you at the time, but she wished she did. But she went ahead and did it. And it took her several months to go through it. It was so painful. She finally got the money, but it was less than even what they promised her initially. So she was like, oh, well, that's unimpressive now. Now I went through all this pain and now I even got less money. Is it really that difficult to go through a process like this?
No, it's not. It shouldn't be. And so we typically will close within 3 to 4 weeks from the day you send back your application to the day you get your money. Normally closer to 4 weeks.
That's much faster.
Because there are certain things that have to happen. There's some documents to go backwards and forwards. Um, we have to get an internal inspection. It's not an appraisal, but we have to send someone out to take some pictures to get
Mhm.
to do a report about the current condition of your home, and that takes a few days. And then we open escrow, and that takes a few days. So there are a
Right.
few things that we do that involve other people, but normally 4 weeks is the right is the sort of time. We don't have to send an appraiser out, so that saves you about $500 to $600. We use automated valuation models
Oh, yeah.
from the same companies that provide those models to all the mortgage companies. They're very reliable. Um, and that's also pretty instant as well. I think what may have happened with your friend is that the industry has gone through a number of changes over the last 3 4 years in particular,
Mhm.
particularly at the time when interest rates changed. And I think what happened then probably was that a lot of the funding that was available to other companies suddenly got pulled because interest
Mm.
rates changed. And these funders said, well, we don't know what's going to happen to house prices, so you can't have any more money. So what happened then is you have this huge backlog of people that have had their applications go through the process, and then they've been told, sorry, we don't have the funding available anymore.
Mm.
So that's not really the fault of the companies because they tend to be getting more and more efficient. So
Mhm.
as they grow, like they start off with um, the sort of early on inefficiencies, but then they gradually become more efficient. And so overall, I think the companies in this space are much better, much faster, more efficient than they were, but they tend to suffer from their own success. In other words, as they become more efficient and as more and more people want to get involved, then the workload increases. So they're sort of dealing with that growth pain as well. I would say the industry average is probably closer to 6 weeks. We tend to be able to close faster because we are smaller and more hands-on.
Mm.
And we just we're much more motivated because we're at the stage, or the size rather, where each homeowner actually means a huge amount to us. And that will change over time as we grow, where we won't, I'm not saying that they won't matter, but you don't have the opportunity to put that same laser focus onto each home. So I think, we're still, to answer your question in a very long way, we are normally a lot faster than the other companies because we're smaller. But I think that your friend's experience, I think, was something that's probably not going to be repeated. You probably don't have that same lengthy process anymore. It was just at that particular time that it was unfortunate that she got stuck in that moment.
Yeah, it was towards the end of 2024. There were still a lot of things happening. Rates were changing and things like that again. So, yeah, that makes sense. I'll tell you though, despite all that pain that she went through, she was very, very grateful because her
Yes.
situation, she had a paid off house. So she got up to 25% of the value,
Yeah.
but it was able to pay off all of her debts, which
Yeah.
saved her about $4,000 a month in debt payments,
Yeah.
which for her, that's huge because now that $4,000 can work harder for her to start actually building some passive income, which she didn't have before, right? So we paid off
Yeah.
debts and it even gave her a little bit of extra cash we could start doing something with to not just save
Yes.
money on the debt side, but then also make money on the passive income side.
I mean, that's a lot. I mean, $4,000 a month.
Mhm.
If you're putting that into something over a 10-year period,
Yeah,
that's obviously it's nearly $500,000. But just the appreciation and the
hmm,
compound growth that you would get from that
that's right.
is huge. So she gets that, and she's got the value of her home, and it's liquid as well.
That's right. No, yeah, it was a dream come true for her, especially where her credit score wasn't great. So the home equity line of credit wasn't a good option for her. But now, because she's paid this off, this is now bumping up her credit score. She's able to fix that, and now it just creates more options again for her in the future.
And that's a lot of there's a lot of truth in that because we're working with um, mortgage originators because they have lots of people that have that issue where their credit score or their debt to income ratio means that they don't get the deal that they want if they get a deal at all. But they can use our home equity investments as a form of bridge that enables them to get their credit score back on track and get their debt to income ratio reduced. So suddenly after, well, I say suddenly, but suddenly after a few months, if that's not
Yeah.
a contradiction in terms, their FICO score is back up where it needs to be,
Hmm.
and they've then got a much wider choice of loans or HELOCs, or whatever they want to do, so they can take out the home equity investment and then go back to a more traditional form of debt if they want to, because it gives them that choice.
Yep. You exactly described her next phase in that
Yes.
process was rebuild her credit back up. So then now she can actually get a home equity line of credit, pay off this investment, this home equity
Yeah.
investment. So then she can get a higher loan to value, get more cash out, and then she has more to invest. So that's kind of like we call that phase two from her
Yeah.
phase one, which was just getting the cash, pay off those debts, free up the cash flow, get her in a much healthier cash flow position. But then as we build up that credit, then we move back to the banks again, especially if we get a little bit better interest rate favorability in the future. That would also help too.
And also, if you look at it from a like a helicopter view, you've got all of these people that are challenged by cash flow, which has reduced their credit score, so it puts them in a position where they can't get out of it. So, in other words,
Yeah.
because you needed to borrow that money, so even though I might have $500,000 worth of equity, which is absolutely not unusual, particularly
Mhm.
in California, where house prices have increased massively over the last 4 to 5 years. So you could have hundreds of thousands of dollars of wealth, and it is wealth because it's your money, your capital that
Yeah.
you can't get your hands on, and that means that you have no option then to sell your home, to liquidate your asset, which you just don't want to do. So this is a great way of actually fixing that problem. And so it does have a lot of real benefits to people that otherwise would have had no other option than sell their property, or declare bankruptcy, or or something more radical like that.
Right. Well, Matthew, I've taken more than your time. I know you were expecting today.
No,
Obviously,
it's always a pleasure. Thank you for again for inviting me back.
yeah, no, it's a pleasure. Third time's a charm, that's for sure.
Yes, yes. Well, hopefully we'll still be here in years to come, and we'll have a different story each time we meet.
Exactly. Well, what's the best way for them to reach out to you?
The website is Quantm RE, so that's QUAN for November, TMRE as in real estate, quantmre.com. And we've got all of our contact details there, email address, telephone numbers. There's a number of videos, podcasts, going back a number of years, just that you can sort of flick through, and you can see the sort of the growth and the genesis and how it's changed over the years. But all the information is there. And there's also a calculator that you can use. We just operate in California at the moment, but we are bringing on new states this year. So we are restricted just to California properties. But, just check out the website.
All right, we will. I'll put that in the show notes. So thank you so much again.
Thank you.
So last question for you that we always ask all of our listeners, because you are on the Money Ripples podcast, and it's always about that ripple effect you can create in other people's lives. Matthew, what do you feel is your ripple effect?
Gosh. Yes, I should have remembered this question. I think just sticking with it, really. I think that's I think having an idea and having faith in something and having the courage of your convictions. So, I think that's relevant, because all of the people that listen to you have the desire to do this and to make those changes. But sometimes they're quite challenging, and it takes a fair amount of willpower and self-belief to be able to stick on the path that you've chosen. So I think you just hang in there, really. I mean, I'm not sure if that's a definition of a ripple, but my experience is, you know what I'm saying. You just if you've got this belief, then have the courage of your convictions, and just keep buggering on, as they say, and until you see it through.
Yeah, keep the faith and persist, right?
Exactly.
That's something that is contagious. When people see that example in you, people want to follow it too. And even if it's sometime they're struggling the most, that's the time that they see your example and they say, man, I think I want to do that too. And it might just be just long enough for them to get that 3 feet from goal, right?
It's funny. The struggles are actually quite fun, looking at them from the other side.
Yeah.
In other words, if you look back on them, it's like, oh, that was quite fun. Going through it's not always, a
not a joyous occasion.
Exactly. No, but it is. I think the best option is just to dig in deeper and just say, "Come on, is that all you've got?" And then, but yeah, that's it. I would just say, just stick with it. If it was easy, everyone would be doing it, and just stay on the path that you describe, and it works.
Yeah. Well, Matthew, I appreciate you sticking around. And like I said, you've been around now, like you say, going on 8 years. Doing this kind of business, which
8-year overnight success.
Yeah, that's great. So again, appreciate your time here, Matthew, and everybody else. Definitely check out. We put the link in the show notes there for quantmre.com. But definitely go check that out, especially if you feel like this could be the answer you've been looking for. Be sure not just to listen to our podcast, but find ways to take action so that your life can benefit right now. Go and make it a wonderful and prosperous week, and we'll see you later.